Hi guys. Okay, so I'm here to go over not last minute tax planning strategies, but tax planning strategies that you can take. Maybe you may be able to throw a couple in between now and time to do your return, or at least it'll give you some ideas of things that you've already been doing all year that you didn't realize mattered. And so I'm going to take it. This might be a little bit of a lengthy video because I'm going through the Ultimate Tax Strategy Guide from Mark J Kohler. It's 30 different steps. All of them will not apply to you. All of them won't apply to me. They're going to be applicable to different people. I will address that as I go through them. But I'm going to, again, this is not tax advice from me. He says the same from him. You can actually look up Mark J Kohler, exactly as written on there, and the Ultimate Tax Strategy Guide, and enter your information, and you'll get the ability to download this yourself. I am not going to make it available for download because it's not mine to make available, but you can get it for free from going to his site. What I am going to do is share some insights that I've seen in going through that I thought, oh yeah, that's really good. And oftentimes as clients ask about specific things related to their strategy, you know, I make recommendations based on that specific client. However, I really like the concept of let's take it up to a bird's eye view. So let's take it up higher and just give, these are all general ways that would be helpful for tax planning, and some may apply and some may not, but that way everybody gets everything and you take what you like and leave the rest kind of scenario. So let's look at, sorry, hit the mic, don't want to do that, I don't know what that does to the sound. We're going to start off initially with, he has a little 30-point tax strategy checklist. I definitely would go download it just for that. It's worth it. MarkJKohler.com, the Ultimate Tax Strategy Guide. And he kind of shows you how all this fits together. So definitely worthwhile. But I'm just going to hit on some of the key points of these 30 steps that he suggests, which will, like I said, be for different people. First is to utilize a Roth with chunking, not a traditional IRA. Okay, so why is that? So the Roth IRA is paid with after-tax money. The traditional IRA is paid with before-tax money. So if you're an employee and you have a traditional IRA, 401k, whatever, that money is deducted and moved to that account before your taxes are computed. So that's the key difference. With Roth, you're going to get your net check, or you can have it, but it's going to be after taxes and all of that have been taken out, and then what's from that net is how the Roth is paid. And so the benefit of that is that the Roth is paid, the money going into the Roth, you've already paid taxes on, so it gets to grow tax-free. So at whatever time, whatever ripe age, over 59 and a half, that you begin withdrawing from your Roth IRA, you are not going to pay taxes on that money. Now, if I can tell you, I can't count how many times, and this mainly with people in academia, teachers, professors, so forth, where they're building this 403B and it's just growing and growing and growing, and they're like, I got 1.2 mil in my, 403B. They're usually not saying that. It would be younger people saying that, but just play along with me, play along with the story. So, but no, seriously, when it's time and they have to take the withdrawals from that, and they're required to have a required minimum withdrawal from that account, and they see the taxes because their home is paid off, everything's paid off, they don't have a side business, they're in their 70s, and all they want is peace of mind and to be able to enjoy that 1.2 million that's been in that 403B. Well, it doesn't quite work like that. First off, taxes are going to come off the top. And then in addition, or 401k or traditional IRA, whatever that is, taxes are going to come off the top. But in addition to that, anything that, even if you had other income and you decided, I don't want that withdrawal, you don't get to choose that. You have to take that withdrawal and you have to pay those taxes. So that kind of comes out with that. But utilizing a Roth allows you to pay taxes at the time that you make so on the money that you're depositing, you're paying taxes. And it's at a time where you have all kinds of different things going on. Like in my life, I have business deductions, I have personal deductions. And, at one point I don't have child anymore, but if you have young children, it's during those times that you want to be doing some of this stuff and putting away in the Roth, because you're able to avoid the taxes now. Pay the taxes now and avoid higher taxes as that money grows, which is exactly what typically happens, and we see the tiers. So the first one was utilizing the Roth. So that was advice. And this is not just tax planning. This is like tax strategy. So this is why I say, definitely go and follow him. If you are on YouTube or whatever, I definitely encourage it. Because at the end of the day, any CPA who wouldn't, I don't have time to be on YouTube all day like he does. Well, I'm not saying that you do, Mark. I'm just saying that you're always out there. But I'm not saying that you do have time. That kind of came out wrong. But it's very difficult if that isn't your only job, that you can be on YouTube as much as he's on there. And so he has a strong team behind him, and he's just teaching away. One day when I grow up, I'll be there. But in the interim, you guys go follow him, see what's going on. And then if you have any questions for me, definitely hit me. And that allows you to kind of take control of your own business and your own taxes to a certain extent, and it gives you questions that you can ask me. Of course, when I do your review videos or whatever that I do, I'm also going to make my own suggestions to you as well. But anything that you have that you can be understanding better to help you be a better business person, why not? Okay. Number 2 in Mark's Ultimate Tax Strategy Guide is state tax strategic planning, possibly moving your house, moving to a different place. And I know I'm in Texas, and we are seeing it. We are seeing people shut it down from California and New York and move here every day. And it's driving our home prices up. And so for those of us who are homeowners prior to this whole migration, we're happy because we see the values going up. However, you sell, and then where you going to live? Because now we can't even afford a house in our own neighborhood anymore, which, so there's give and take on that. But I do, I think it's a good thing for Texas. And obviously it's a good thing for taxpayers. I don't know about traffic. But anyway, so that's an option. There are 8 states that have no income tax at all. Those states are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. 3 states don't have 401k, IRA, or pension distribution taxes, and that's Illinois, Mississippi, and Pennsylvania. So all other states have taxes. And so, for instance, in California, you're going to pay your federal taxes, then you're going to pay your state taxes, and then you're going to also pay sales taxes. And if you have a business, then there's business property taxes. So it goes on and on and on. And so that's why a lot of the Californians are headed down to Texas. So that's one thing that you could take a look. If you're my client, you're probably somewhere in this vicinity or in one of those states. I think I have a few that are not in those states. So, we got some Louisiana, we got some New York, and we got some California. And for whatever reason, they're fighting through on the taxes with that. But yes, if you have the option to reconsider where you live based on taxes or live certain places part-time, definitely that's a consideration. And now that almost everybody has, I'm not going to say almost everybody, quite a few people have the ability to work from home or work from anywhere. It really opens the door to that. Number 3 is start with a cover down for kids' education instead of starting with the 529 plan. And the biggest thing with the cover down is because it can be self-directed. So you can only put $2,000 in there, period, per child. So you can put that in there per beneficiary, not child, but beneficiary. So you can put that $2,000 in there every year and let it add up. But the benefit is you get to self-direct it. So it doesn't have to go into stock or into whatever fund they're using, the administrator's using. You can actually self-direct that. And one of the things that Mark Kohler, one of the companies that he has is Directed IRA, and it's for self-directed IRA plans. That is not something that most CPA offices have. And so definitely look into it. Your financial planner, if you have a financial planner, and I do have some if you don't, can help you get connected. Also, if you didn't want to necessarily use the one that Directed IRA that Mark has the podcast with, there are other options. However, after that, you can your Roth. Remember that Roth we talked about, that beautiful Roth that once you're 59 and a half, you get to pull money out tax free. That's another option. So after you've done your cover down, then maybe look and see if you have some money, if you're over the age of 59 and a half, that you could pull out tax free from your Roth and use that to help with children or grandkids college. And then last but not least, so first you're going to fund that cover down, then you're going to fund your IRA, your Roth IRA. So that's after tax money. You don't get a discount on your tax return, right? You're going to fund that. And then you look to the 529 plan. Okay, which is a tax-free plan that allows you to save money for your kids' education expenses. It has the same benefits in that it's tax deductible at the time that you contribute that money, but that money has to be used for education expenses. Okay, so it has to be used for education expenses. All right. Number 4, utilizing a health savings account. So utilizing a health savings account is one of the most powerful pieces of a well-designed healthcare strategy and wealth building strategy. So with HSA, you can put your money in an account, have it deducted from taxes, right? So you're not paying taxes when you put that money in there. However, it can only be used down the road. It can be used to pay for your high deductible health plan. It can be used to pay out-of-pocket health expenses or medical expenses. So those are the benefits, and you get an above-the-line deduction at any income level for your HSA, which is wonderful, which means that is going to reduce, not only is it reducing the amount of money you're going to pay taxes on, but it's actually in some cases going to reduce the rate that you're going to pay on all your money, because it is an above-the-line tax deduction, which means it comes out before we get to AGI, which is beautiful. Let's see if there's anything else I want to say about this HSA bucket. There's a ton of different suggestions that Mark gives, but with regard to overall tax planning, which is where I'm coming from, not so much the estate side, they do kind of start overlapping from a tax planning standpoint. What you would need to know is that if you have healthcare expenses and you have a high deductible health plan, a health savings account is good for you. And there are all kinds of other ways that you can actually, with the health savings account, you can actually, again, self-direct that. And so you can use that money to grow. You can grow it however you want to grow it. However, when you pull the money out, it does need to be for healthcare. So consider it like a portable Roth IRA for healthcare. So that's kind of a neat thing. There was something else I wanted, or something I said that, let me see what it was. I don't know. I don't remember. It was something I was going to say there, but it must not have been meant for me to say it, because it is gone. And that's what happens. Over 50, I quit fighting. I'm 54 now. I'm not fighting to remember anymore. If it's gone, it's just gone. I wasn't meant to say it. Staying ahead of IRS penalties and interest. Okay, if you're my client, you already know. Like, this is what we do. We try to avoid penalties and interest from the IRS. Yes, in some cases, can I get them off? But you're paying for me to get them off, and we can avoid them in the first place. How do we avoid them, Kedra? How do we avoid them in the first place? Avoiding them in the first place, paying your taxes on time. Our tax system is considered a pay-as-you-go system. So if you think about pay-as-you-go electricity, or I don't know if that actually exists, but pay-as-you-go cell phone usage, whatever, where you pay for so many minutes, you get so many minutes. You pay for so many this, you get so many this, or all the subscription services that we have now and all of that. Our taxes are like that. So in essence, our responsibility is when you determine that you owe those taxes, that's when it's due. So as you earn income throughout the year, you get your paycheck every week. They make tax deposits every week. You get your paycheck every month. They have tax deposits every month. So however that works, there's a responsibility that goes with that money moving. So with your employer, if you're W-2, they're required to make that deposit right within a few days at the max, within 15 days from the end of the month. If you are a self-employed individual or a small business owner, you're responsible to be making those deposits. And there are not just payroll tax deposits. We know we need to make those for our employees that we pay, and then we're given the amount of tax deposit for them, and that needs to go in depending on whatever type payer you are. But we also need to be making estimated tax payments for the income tax that we're going to end up owing at year end, especially for an S corp. So your W-2, you're paying yourself W-2, the taxes are being withheld, you're paying in enough taxes there, but then the company overall makes $100K after taxes. I mean, after all those deductions for payroll and payroll taxes, after all that, now you have to pay income taxes on that $100K at your personal tax rate, because an S corp is going to roll onto you personally. So it is important that you account for and plan for what income is going to roll over to you from that S corp, or if it's a C corp and it's going to pay you dividends, you need to plan for those dividends that are going to be paid out. If it's stock and it's up and you're planning to sell it and you know you're going to have a gain or a loss, you want to plan for that so that you can make estimated tax payments throughout the year when those activities occur. And then you're not waiting till the year end to be shocked by the balance. Okay. So these are the most common types of penalties and interest that hit American taxpayers. Late payment penalty on your personal taxes. So yeah, not paying in enough, not paying estimated taxes. That's going to get you every time. There's two penalties that apply there. There's the penalty at 12/31 that you are really January 15th that you have not paid in throughout the whole year enough, and you get penalized for that. And then when you actually file your tax return, if there's a balance due over $1,000, you're going to get penalized for that. Okay. And then if you don't file it, you're going to get penalized for that. So no matter what, there's penalties all over the place. The way around IRS penalties is compliance. Okay. You're going to estimate your taxes. I think I did another video on this page or on the CPA page, but it talks about an easy way to do that is look and see. You'll see what your adjusted gross income is. You'll see your standard deduction and your exemptions, and then you're going to get your taxable income. When you look at your taxable income, just below that is going to be the tax. This is on your tax return, the tax that you're paying, not what's owed because you underpaid, but the total tax that you're paying. You're going to look at that. You're going to look at your pay stub for what's been withheld year to date on my pay stub. So let's say the tax that you overall tax is $10,000. Year to date, you have $8,000 that's already, you were in December, already been withheld. So you know you're going to owe $2,000, right? So you already know that. You want to go ahead and make estimated tax payment for that amount now if you haven't made it throughout the year. Now, had you done that little workup early in January and realized you were going to owe $2,000, then you'd pay $400 a quarter. I'm sorry, $500 a quarter. $500 a quarter to make sure that you've paid in enough taxes. Okay, so that late payment of personal, that's a big one. Failure to file penalty. That's for not filing. That's 25% of the balance due. That's an ugly, ugly penalty. That should never happen. That should never happen. You just need to file. Even if you can't pay it, still file it. Okay. And then the penalty for underpayment of estimated taxes. So always know, like I just said, you want to make sure that you at least pay just to be safe. I'm going to give you one rule. There's 3 different rules in here, and I could go through each one and then you leave it with you, and then you go home and go, well, did she say I need to pay 90%, 100%, or 110%? I don't remember. Any little thing when it comes to taxes, any little thing will be the thing to make you stop. It'll be the procrastination maker. So just don't even do it. Just 110%. So whatever taxes that you owed last year. So look at last year's return. Look, like I said, the total tax. Make sure that you pay in 110% of that with the current year stuff, or 90% of the taxes you're going to owe. But yeah, see, that gets to be tricky. Go with the 110%. Ask your CPA or tax. If yours is not that simple, then you need to be using a professional to do your taxes. You need to have a CPA. And I don't care if that CPA is Kedra Flowers CPA, Flowers and Associates Tax Relief, or the Mark J Kohler. I forget what his is called, but if it's them, I don't care. What I'm saying is that you need to have that taken care of, because you're just giving money away by not doing that. So that's number 5. Let's see, number 6. On the 1040, I'm going to skip this. This is really just talking about the difference in itemized deductions that came about with the TCJA Act. tracked. And many people, especially married people, won't have enough in itemized deductions to exceed what is the current standard deduction. So you'll want to look at that. You still want to keep track of that. Sales and use tax. You want to track your real estate taxes, your mortgage interest, and interest rates have gone up. So if you bought a house recently or even bought anything recently, you're going to see that you're probably paying, the prices are up and the interest rates are up. So you want to be, kind of following that. Charitable contributions, right now people don't usually, like I said, get a chance to do the itemized deduction. One way to get up there is, let's say you give itemized deductions. You give charitable contributions of $10,000 every year. So maybe what you do is you alternate and pay 1 year ahead, so that 1 year you're doing $20,000, which is going to knock you up above that standard. So that's an option that you can do as well. But again, any of these types of options, whether it's real estate taxes, mortgage interest, charitable contributions, if you gamble and you have gambling winnings, then your gambling losses, you want to track all those things. But understand, all those things are spending money. So when people say, I want a way that I can save on taxes, I'm going to be the CPA whisperer and say what they really mean is, how can I save on taxes but still keep the money? And usually there's not really a way that you get to do that. If you keep the money, there's depreciation. There's depreciation on your vehicle where you keep the money, but you bought the vehicle on credit. So there's some little ways like that, but there are already ways that we're talking about. There's no way that you can, I'm not going to say no way. I had to really think about it, but there's not very many, if any, that aren't already identified, like depreciation and things like amortization, things like that, where, you're not actually spending the money, but you're getting the deduction. So those exist: mileage per mile per diems, things like that, travel per diems, things like that. Those are already part of the tax code. If it's not already, then definitely ask your tax professional, or if my client asks me, because we want to make sure we don't get you crossing no lines with that, because tax avoidance is legal, tax evasion is not. So I always point that out. Number 7, know the tax credits that may apply to you. So whether you get earned income credit, child and dependent care credit, I'm just going to list all of them really quickly. I think it's important to know. You'll know whether or not it may apply, and then you can ask me if it's one. Most of my clients are going to be on the right side, but let's go through these on the left side, because occasionally there are. So personal tax credits on your 1040, earned income tax credit for people whose income is below a certain amount of poverty level, and they get credit for each child up to a certain number of children. The child and dependent care credit, that is child care for you to be able to continue working. That is what that is for. So if you pay for childcare, you should get an EIN letter from the childcare center, as well as how much you paid for the current year. So you can receive a percentage of that as a deduction, or as a credit. The child tax credit, which we know is for each child that you actually have. Saver's tax credit. If you save, there's a percentage of or a blanket credit that you are entitled to get. And let's see what that is for 2023, because that would be a neat thing to know. You know what? I don't want to mess up my screen. So I'll do a whole nother video on the Savers tax credit. The lifetime learning credit and American Opportunity tax credit. Of course, those apply to education, those who are in college and are in your parents' income or your income is below a certain threshold, then that could qualify. And of course, you have the energy tax credits, clean vehicle tax credit. If you have an EV, there's a credit that applies there. And then adoption tax credit. If you've adopted a child in the current year, then there is a credit that goes along with that. Now, on the right side, we have credit for small employee pension setup. So you get a credit for setting up a small employer pension if you're under a certain size company. Same with healthcare, providing healthcare to your staff. If you're a small business, there is a credit, and you can take up to a percentage of healthcare premium payments that you've made against your taxes in the current year. And again, all of these apply to small business owners, and so there is a limit and a threshold for each. The business clean vehicle tax credit, which would be similar to the EV credit for businesses, investment tax credit, federal fuel tax credit, credit for family medical leave, FMLA. So if you paid someone for FMLA, then there is a credit that you can take against your income tax for the money that, or the cost of that personnel for you, or paying for that medical leave. Work opportunity credit, that's an incentive credit to give work to individuals who are close to or below the poverty line. And if you hire someone and they have previously been on federal aid, like food stamps, housing, things like that, but your job gets them, you're giving them an opportunity, then there's a credit that's available for that. And then small business research and development credit, which is now called the SRD, or specified research expenditure, SRE, not SRD. Okay, so those are the credits. I'm listing them out. If any of those do a earring for you, where it's like ding ding ding, that might be me. I think I might qualify for research and development, or those are things that you should ask your tax professional about. Now, I will say this, and let me throw this shameless little plug in here when we're talking about this. The credit for whatever these credits are, all of these credits they're going to be unique to you and your situation. So it is important that you make a note and then you ask, because I'm not with you every day in your business. And so I may not know that you provide health insurance to all your employees instead of just your family or something like that. So the reason I'm putting this out here is I want to give you the information so that you can have the questions for me that can help me help you. So that's basically where we're going with that. Number 8 is self-direct your retirement accounts, which means you can self-direct your retirement accounts into any of the following: rental properties, private notes, real estate development, small business, crowd funds, startups, cryptocurrency, NFTs, precious metals like gold, etc., etc., etc. Now, I do not nor do I have a company that I could refer to that does self-directed that I'm aware of, IRA. If you are already one of my referral partners and you do offer this, please let me know so I can put a note under here to let you know. But I do know Directed IRA. That is a podcast that I listen to, and that is where Mark J Kohler came from, and has gotten, I don't know if that's where he came from, but he's gotten pretty popular with that. And so if you're looking to do self-directed, I definitely would advise you to use a reputable company and get that done, because what you can do is cause your IRA and your retirement fund to grow faster than any other rate that's there, than any mutual fund or just basic investment. You're actually able to invest it in something that is going up. Real estate's going up. Well, right now everything's so high, I don't know. I'm not giving any financial advice at all. So skip what I just said, back it up, throw it away. Mark J Kohler, Patty Lee, spelled Patteelee, and Chuck Burch, Chuck CHUCK BURCH, the Burch Financial Group. So those are, I will also have those in the link below. Those are the financial. I'm not sure what just happened. I think I accidentally cut off. So I'm just going to come on right back in. I think I accidentally I did. Hopefully it hasn't been for long. So part 2, this is number 9 on the Ultimate Tax Strategy Guide. Okay. Building a small business, even a side hustle. So of course, everybody who has a day job is trying to start these small business side hustle, money saving things. But here's the problem, coming from a CPA who specializes in audit representation and tax relief. The majority of clients that come to me under audit are people who had 100K in W-2 income and then 60, 50, 40K in a Schedule C loss. And the reality of that is just not, in order to have a $40,000 or $50,000 loss on a Schedule C means that you spent I mean, some of it's going to be depreciation, but even if it's depreciation or mileage expense or any of those things, you have committed to those expenses. And so to have, that kind of a loss when you're basically is saying, okay, I am going to work every day. The government is going to take 30% of my check. So I'm only coming home with 70,000. It's probably going to be higher than that if you don't have anything else to deduct. So, but you're coming home with 70,000, and then you're spending 50,000 on a side business. How are you living? So the thing is, it needs to be real, right? It needs to be real. A side business, side hustle. I braid hair on the side. I mean, I don't, but if I did or whatever, yes, the cost of the hair, the cost of all the, whatever. Yes, you get to deduct all that. But you also have to include the income that people paid you. So you're not going to pay $10,000 on hair for somebody's hair and they only pay you $1,000. It doesn't seem to make sense. So it's not that they're picking on these side hustles. It's that the numbers don't make sense. The numbers tell a story, and the story needs to make sense. So I want to say that. But if you do have your side hustle, whatever little side thing you do, I do art. I have all kinds of little stuff. A lot of it is just hobbies. I've never made $1, so I don't put that. I don't list that because I haven't made any money on that. Nor am I doing it to make money. It's just something I love to do. But if you're starting a business and the intent is to make money, or you're starting a hobby and you accidentally make money, you are required to include that money, and you can include the expenses up to the amount of that money. That way you don't pay taxes on it. Okay, that's how hobbies work. But you don't get to take the loss beyond that. Okay, so we just want to be real careful. Now, if it is a real business and it is a real loss, then yes, you're going to take your real loss. And we're not afraid to be audited. We're not. Now, understand that being audited still ends up costing you money if you have to hire somebody to represent you. But we're not afraid of being audited if what we put on the tax return is accurate. So that's all I would say on that. And then I'm going to move forward. All right. This is still number 9, building a small business or a side hustle. I'll tell you, and this is a little bit aside from that, but I just want to throw out, oftentimes you may start out with something being a side hustle, and it's like, yeah, I would, but I would recommend your side hustle be that thing that you love to do. Like, I love to do art. I love to do AI art, things that you love. I love painting, things that you love to do, but it doesn't pay the bills. Let that be your side hustle, because you would be so happy to realize that a lot of times that side hustle will end up, once you open the door to making a profit and you get intentional about making a profit, it will turn a profit for you and you'd be very happy. And I don't want to manufacture a loss. I want a profit. I want to make money. If in order for me to make, another 300,000 with my side hustle, I've got to give the government 100,000 of that. That's okay, because I still get to keep the other 200, right? So, but again, all of that plays a part with staying compliant and staying on top of it so you don't have any issues. Okay, number 10, buying rental properties. So again, I'm not going to go deep into this. There are all kind of places on real estate websites and but I will just touch on buying rental properties or having rental properties. The expenses of those properties are tax deductible for you. You also get the benefit of depreciating those properties. So you get tax deferred growth because you bought the property after tax money. So you're not going to be taxed on, the change in the value of that property until you sell. And when you do sell it, you're going to get capital gain treatment, which is really nice. It's going to be much lower than your effective tax rate in many cases. You get all kinds of flow through tax write-offs, mortgage interest, real estate taxes, lawn care, potential utilities if you cover part of the utilities, all of those things. And then there are all kinds of additional real estate exchange. And you can download this document yourself. That's why I have it on the screen. You can go there, you can Google it, go download that document directly, and you can read everything in it. I just want to make sure that I'm flipping through the big ones to make sure that I mention them to my clients because I think this was just a great way to have this all summarized. Utilizing an S corp. Utilizing an S corp is a way to save some cash flow. Now, what does an S corp do? This is not saying Mark is saying this. This is me following his guide, and then if there's something on there I want to grab, I'm gonna grab. Like this, something says wrong. This is blind reaction. I guess I should say too, because I have not necessarily read this before. So I'm giving you my feedback at the same time. It says utilizing the S corp. When is the time right? So many Americans have been brainwashed into thinking the LLC is the first and best move when starting a business. Wrong. The problem is that if you sell products and services, receive commissions, flip properties, or get a 1099, you're generally going to create ordinary income. Individuals and LLCs will pay self-employment tax of 15.3% on a large part of the profits. The benefit of an S corp is you get to avoid that. So whether you're an LLC and you convert or make the election, it needs to happen within the first 2.5 months of your LLC setting up, or before you file the first tax return or any other return that would conflict yourself being an S corp. You could elect S corp for that LLC. So that is important to know. Out of this. So if you are an LLC, this is something that can happen at the end of the year. If you're an LLC and you'd like to be an S corp beginning January 1, 2024, which means 2023, you're going to file the regular return the way you've been filing as an LLC on your Schedule C. But beginning in 2025, when you do 2024's tax return, you will be an S corp, and you have the benefit of controlling how much self-employment taxes you pay. There are other requirements. It's not just taxes. So this is one of those that if you're thinking about it and you're not sure, you need to get a tax planning appointment scheduled with me almost immediately. If you're trying to do it for this year, you definitely you can't even get on my appointment. You need to call, if you call the office and let them know that it's urgent because you're trying to get an S corp election before 12/31. You need to tell them that, and so that they can get in touch with me or with someone on our team so we can get that done for you. And that is only for existing clients. No new clients. No. What I would recommend is that you do that with whoever did your taxes for last year, or you can just go online and do it. As a matter of fact, that may be another video I'll show. But as far as that's concerned, with an S corp, you can avoid the self-employment tax, which is 15%. And so the income that comes from that S corp flows over and it's taxed just at your ordinary income rate. Okay. So S corp is not always the best. It is not. However, for Mark J Kohler, he always, to quote him, he says, I don't know of one single way that, being a C corp would be better. There are ways that it would be, but there's a specific audience he's speaking to. And so just understand, if you're part of that audience, then he's probably right, but it is not true for everybody. So if you're not sure whether you should be an S corp or C corp, then that is what your CPA can help you with. Or you can definitely reach out, to us. And this never goes away. You can, if 12/31 comes and goes and in January you decide you want to become an S corp, but you wanted to in January, well, there's a couple of options. One, we could close the existing entity and create an S corp effective February 1st, right? So, I mean, these years are kind of, they're set, and we believe that 12 months is 12 months and da-da-da-da-da. And so January is the beginning, December is the end. That doesn't always have to be the case. So nothing is ever really missed. You can always do it after. It's just that, it requires a little bit of extra planning and a few extra steps and probably some extra money, to be honest with you, because we would be closing down one entity, opening up another entity. So you're kind of doing the 2 tax returns all within this little short period. So it's nice to do things right on your tax year-end date, or right within that time. Okay, number 12, healthcare write-offs for small business. Here are 3 options. Health insurance is 100% deductible for the small business owner. Even if you don't cover your employee's health insurance, you can write yours off. This is huge. So you can deduct your health insurance for yourself. You can set up a health reimbursement arrangement. It's a great way to provide, if you have quite a few health conditions like myself, it's a great way that you can provide benefit plan to not just yourself, but yourself, your employees, and your family members that work for the company, that you can get a deduction against the medical expenses. And then, as mentioned earlier, you can also take the health insurance tax credit. If you actually do pay for some portion of your employees' health insurance premiums, the small business healthcare tax credit for small employees is ripe for the taking. This little gem is a literal dollar for dollar tax credit against your income. And it is for the health insurance that you paid for as a small business for your business, for your company employees. I'm switching to anything. Okay, autos, trucks, RVs, and more. We've already talked about that. So most people know if you have a business vehicle, you can deduct either actual expenses, which is gas, insurance, cost of the vehicle, depreciation, all that, or standard mileage. So if you're you do, I don't know, sightseeing tours, when you're constantly driving around, or you're picking up childcare children or whatever, you can track your mileage. And they have so many little apps that'll track it, and you can click, this is personal, this is business, this is personal, this is business, and track your mileage throughout. And at this point, the mileage rate is up to, at least as of 2022 was raised to 62.5 cents a mile. Now that percentage goes up. It goes up as each year changes, so you'll always want to check that. And then, of course, your actual expenses depend on what you actually spend, right? So we've talked about that earlier.
That was great. So imagine what it would be like if you had a CFO or virtual CFO by your side the moment you started your business. Where would your revenue be today? High six figures, 7, 8 figures? Who knows? But I can tell you, for me, had I started my business at 23 with a virtual CFO, I'd be retired by now. That's just the bottom line. I would be retired. But back then, that wasn't even a consideration. Like, the world has changed so much. However, now you have the opportunity, whether you are a solopreneur, whether you own an actual business and you have an in-house accounting department, but you still need that level of expertise that's beyond just presenting the reports to you. It's understanding, interpreting the reports, and then being able to communicate that to your CEO or yourself in a way that gets results. That is what a virtual CFO is for. So if you're interested in this service, we'd love to have you on board. You can go into your client portal link and schedule an appointment and put virtual CFO. That way we're ready to present to you what is available for that gives us time to visit your history and so forth and make some recommendations for you. If you are a new client and there is no history, definitely just reach out to us. You can just give us a call at the 469-449-9833, and they can get you scheduled for a new client appointment. All right. Thanks so much for your time, and we'll talk soon. Look forward to bringing you on board.